In today's video, I want to look at the worst time periods to retire in US history. Now, to define worst time period to retire, we are going to look at the lowest safe withdrawal rates based on that year of retirement. What we're hoping to find is, what kind of lessons can we learn and how can you kind of respond in your retirement? Now, my name is Scott Caufield. I am a CPA and CFA charter holder and the founder of Sophos Wealth Management. So we've got some great data on this, both from Michael Kitces and Pfau, a lot of guys who have done deep research into safe withdrawal rates. First of all, what were the worst periods to retire in US history? That's going to be 1907, 1929, 1937, and 1966. So let me show you a couple charts here. First one comes from Michael Kitces. So this is showing a 60-40 portfolio. You're going to see some of these lowest safe withdrawal rates in history. So like we said, we got that 1907 period, and you can kind of see the early 1900 to 1910, 11, 15, not a great period. You've got that 1929 period, not very great. And also right before it, not very good. 1937, again, not very good. And then 1966 was actually the worst in history on this data. And you can kind of see, though, that whole 1960 to 1975 period, not a great time for retirement there. Now, another chart based on a little bit different data comes from Pfau, and I actually got this one from portfoliocharts.com too. It's showing basically the same data, same conclusion. So we've got 60-40 asset allocation, 60% stocks, 40% bonds, 30-year time period. Again, you're seeing those lowest periods, right around 1907, right around 1927, 37, and then that mid 60s, 1966. So not great periods. And also, this kind of lines up with some of the best periods. Funny enough, some of the best periods often follow some of the worst periods. But what can we actually learn from these poor periods? What do they have in common? I like this table that Michael Kitces has put together, and he says, what does the 30-year data show? What actually happened in these low safe withdrawal rates to stocks, bonds, inflation? So let's take a look at this. These are nominal returns, meaning we're not taking into account inflation. We've got those 4 periods I mentioned. Now look at 1907. So over this 30-year period, that was actually the worst period of these 4 data sets for stocks. So about a 7.8% return. Bonds, quite strong, 4.25%. So that's 60-40 being rebalanced annually, I think, about a little over 7%. And inflation actually below its historical average, 1.64%. If you go to the far right, too, you're going to see what the historical averages are. Based on his data, the historical average for stocks, 10.35, bonds, 4.81, a 60-40 rebalanced portfolio, 8.13, and inflation 2.23. So you can see stocks, especially below their historical average for that one, hurting the return, but inflation was pretty good. The 1929 portfolio, again, stocks below average, but frankly, not that horrible. 8 point almost 2. Bonds quite bad, 1.74, so quite a bit below their historical average. Inflation again below historical average, so nothing really jumps out here. And then the 1937, is quite interesting to me because the equity returns are basically at their historical average. The bonds, yes, about half average. And inflation, I mean, above average, but not anything just screaming high. And then you look at 1966. So you've got equities almost right at average again. You've got bonds well above average. The real, brutal thing about 66, and this is the reason that whole 1960 to 75 period has low withdrawal rates, inflation was real high there in the 70s, 80s periods. So 5.38%, well above the historical average. That was a rough time to retire. What Kitces has found with all this data is that the correlation between stock returns to safe withdrawal rates on a 30-year time horizon is not significant. It's a negative 0.09 correlation. So 1 would be perfect correlation, 0, absolutely 0. What is the takeaway? Well, on a 30-year time horizon, it might not be that significant, but Kitces ran the data on a shorter time horizon. What about the first 15 years of retirement? And that is where we find some real takeaways. So let's look at the same data. Now we're going to look at real returns. So not nominal, but real, meaning after inflation, and only on the first 15 years of the retirement period. You can see that 1907 the stock returns were negative 1.47%. So negative real returns the first 15 years of retirement. 1929, 1.07. 1937, 3.45. 1966, negative 0.13. So compared to the historical average, 8.39, these are all atrocious equity returns in the first 15 years of retirement. Bonds, by and large, pretty bad too. The only one that was decent was 1929, 1.79. I mean, I guess 66 at 1.08 was okay as well, but it is below the historical average, but it's the equity one that has really been rough for these portfolios. And, even the balanced portfolio for all four portfolios, not very good, or all four time periods was not good relative to the historical average. Now, inflation on these four periods, again, the only one that really stands out was 66. Now, this has way more, I think, importance for retirees. Bad returns the first 15 years is what has led to the really poor retirement periods. In fact, Kitces ran the correlation, and the 15-year real return of the portfolio has a 91%, 0.91 correlation to the safe withdrawal rate. So if you get bad returns, real returns in the first 15 years, you're going to have a real low safe withdrawal rate compared to history. Well, how do we know what kind of returns we're going to get? There's no perfect way to predict it, but surprise, surprise, valuation has kind of been by far and away the most valuable tool. When starting valuations are high, typically safe withdrawal rates are low. And when starting valuations are low, safe withdrawal rates are high. Kitces ran an analysis on this and found that there is a negative 0.65 correlation between the starting Shiller PE or CAPE ratio and the safe withdrawal rate. Now, 0.65, not as strong as the 0.91 correlation of the actual returns, but that has decent predictive power. It's about as good as anything you're going to find in terms of what you can base your safe withdrawal rate on. So, and I mean, to me, it just makes some intuitive sense, right? If I can buy stocks for cheap, I'm confident that they're going to have decent returns over the next 10, 20 years. That's going to support a higher withdrawal rate, and vice versa. If I have to pay sky high valuations, that leads to some negative outcomes, some potential for big withdrawals, or at the very least, just lower returns. So this chart from Michael Kitces basically shows Shiller CAPE versus safe withdrawal rates. Now it's actually kind of an inverted Shiller CAPE. So they're actually looking at what the earnings yield are based on the Shiller CAPE. So it's on the right-hand side. Highest earning yields based on the CAPE was 19%. So that means Shiller CAPE is, 6, 7, 5, 6, 7, so mid-single digits. At the Shiller CAPE's highest, you're getting an earnings yield down close to 3%. Not very good. And on the left, you're seeing the safe withdrawal rates plotted. So when earnings yields are high, that means stocks are cheap, and safe withdrawal rates have typically been pretty high. I mean, that's not a huge surprise. So, I mean, you look at the correlation between these two, it's fairly strong. And, the takeaway is when stocks are pretty cheap, you might be able to get away with a higher safe withdrawal rate. If you're looking at a Shiller CAPE and it's in the teens, you could say, this is probably going to support a higher safe withdrawal rate than a Shiller CAPE when it's at 30. And Shiller CAPE today is near some of the highest levels in history. So to me, based on history, that would say we have a moderately predictive environment of low safe withdrawal rates going forward. Now, there's not a whole lot of leverage you can pull here. I mean, one, when you've got really expensive stock, you want to do kind of two things. One, plan for a lower safe withdrawal rate. Two, be maybe a little more strategic in your asset allocation. I've looked at safe withdrawal rates in past videos based on your asset allocation. And for those going for super, super high safe withdrawal rates, you do want a very heavy equity portfolio, but that would be based on better valuations. The lowest safe withdrawal rates in history have come from 100% stocks portfolios. And that's when stocks have done horrendously bad, like 1929. So, you'd want to make sure that you probably have a balanced portfolio or maybe even be more strategic, right? So if stocks are very expensive, you could consider underweighting equities until stocks are maybe more reasonable and then go to maybe more of your target equity allocation. Either way, probably some adjustment needs to be made unless you're just going to start with a low safe withdrawal rate to kind of be careful. So hope this gives you kind of some food for thought. The big takeaway is the first 15 years of retirement and those real returns are the most important. It's hard to really predict what inflation is going to do, but you can kind of somewhat map out what your equity returns are going to do over the next 10, 15 years. As I said in other videos, there's projections out there from Vanguard and Morningstar and others, all kind of projecting 3 to 4% returns over the next decade for stocks in the US. Not great, not supportive of high withdrawal rates. So appreciate it if you like this video, subscribe to my channel and share it with anyone you think would benefit. Appreciate it.